What's up everybody? I'm glad you made it this far. If you haven't seen part 1 and part 2 of this video series, be sure to go watch them right now and then come back to part 3. If you've made it to part 3, you are a financial warrior. This is the good stuff right here in part 3. Prepare to learn about the top investors in the world, strategies for picking index funds, and how to choose an asset allocation and set it up so that you can set it and forget it, go do whatever else you need to do in your life, and just let the money keep on growing and raking in. So now that you've decided on how to allocate your portfolio between stocks and bonds, let's move on to discussing the portfolio structures that can potentially provide you with the returns that you hope to achieve. Okay, so the first most basic portfolio structure that we are going to talk about is the 2-fund portfolio. The Taylor Larimore 3-fund portfolio, there's a Vanguard 4-core portfolio, there's the Coffee House portfolio, David Swenson's portfolio, Frank Armstrong's Ideal Index portfolio, William Bernstein's Coward portfolio, Harry Brown's Permanent portfolio. Now I'm going to discuss 4 of these well-known portfolios, from most simple to a little more complicated, but still it's not too hard. They're all pretty simple to do. So here are 4 great index fund passive portfolios that are a great start for any investor. Now remember, based on how you want to divide up your portfolio between bonds and stocks, you can scale these portfolios to your own bond stock allocations. For the sake of remaining conservative on YouTube, we're going to use a 40% bond and 60% stock asset allocation for these examples. First, we're going to start with the 2-fund portfolio. This consists of buying 2 index funds, a total US bond market index fund and a total world stock market index fund. With the 60-40 stock bond asset allocation, 60% of your money is going to go and be invested into the world market, and 40% of your money is going to go and be invested into the US bond market. So if you have $100,000 that you want to invest, you put $60,000 into the world market index fund and $40,000 into the total US bond market index fund. It's that easy. You just buy 2 funds and you set it and forget it. All right, so now we're looking at the returns from the 2-fund portfolio for the past 9 years. As you can see, in year 2017, the world stock market went up by 24%, which is pretty crazy. The total bond market went up by 3.5%. Now, depending on how your portfolio is allocated based on the structures that we went over previously, if you were allocated 80-20 in stocks bond, your money would have grown almost 20%. If you were allocated 60-40, your money would have grown almost 16%. If your money was allocated 40-60, you would have grown 11.7%. And if your money was allocated 20-80, you would have grown 7.5%. So as you can see, there are some negative years, but for the past 9 years, it's mostly been positive growth. The next example is called the 3-fund lazy portfolio. Now this portfolio is super cool because you keep the stocks the same and then you divide the total world stock market into the US stock market and then everything else in the world excluding the US market. So now you can control both your national and international investments separately. In this portfolio, we're going to keep 1/3 of the 60% of stocks. So that's 20%. We're going to take 20% of the total 100% of money invested and put that in the world market. Then we're going to take 40%, the remaining 2/3 of the 60%, and put that in the US market. So the total asset allocation for this portfolio looks like this. You buy 3 index funds. That's it. You just purchased 3 index funds. If you have $100,000, you buy 1 index fund, you put $40,000 in the total US bond market. Then you buy your second index fund, you put $40,000 in the total US stock market. And then you take $20,000 and you buy your third index fund and you put that in the total world stock market excluding the US. So there's 3 index funds, that covered those three sectors of the market, and you just buy 3 funds and then you set it and forget it. Now again, the strength of this portfolio allocation is that it allows you to control your US, your national investments separately from your international investments. That's the strength of the 3-fund portfolio over the 2-fund portfolio. Okay, so here is the 3-fund portfolio. Now this 3-fund portfolio is a slight variation of the 40% total stock market, 20% total world stock market. This actually puts 42% in the total stock market and 18% in the total world market. But that's okay because there's slight variations and you can always tailor it to your own personal taste. But here are the annualized compound returns for all of the different variations. So let's look at the 60-40 allocation because that's what we're using for this example. So the 3-year annualized average compound return on this portfolio is 7%. And 5 years, 8.5%, 10 years, 6%, 15 years, 8%, and 20 years, 6.62%. The next portfolio is called Rick Ferry's 4-fund portfolio. Now there's 2 well-known 4-fund portfolios. There's the Vanguard 4-fund portfolio, and then there's Rick Ferry's 4-fund portfolio. We're going to talk about Rick Ferry's well-known 4-fund portfolio. Now the purpose of this portfolio is to carve out space for the US commercial real estate sector of our market. So this portfolio structure, the Rick Ferry Core 4, it takes 10% of the money from the 60%. Remember, we're always leaving 40% in bonds because we said that at the very beginning. But now it takes 10% of the 60% and invests that in the US commercial real estate market. So it takes 10% of the 60%. In other words, it takes a total of 6% of the $100,000 that you're going to invest, and it puts it in the US commercial real estate market using REITs. So let's look at the total asset allocation for the Rick Ferry Core 4. You put 40% in bonds, 6% in US REITs, and then you're going to put 36% in the US market, and then you're going to put 18% in the total international market. So that's 4 funds. You only have to purchase 4 funds because the index funds cover the entire sectors of the market that you want to put your money in. Okay, so here we have the average annualized compound returns for Rick Ferry's Core 4 portfolio for 4 separate asset allocations between stocks and bonds over 3, 5, 10, and 15-year windows. So let's look at the 60-40 allocation again. Now we are looking at the CAGR, the compound annual growth rate. So the 3-year window, it has a 6.7% growth. The 5-year window has an 8.3% growth. The 10-year window has a 6% growth, and the 15-year window has an 8% growth. So the next and final portfolio we are going to talk about is David Swenson's lazy portfolio. Now, David Swenson is one of the first investment masters that I learned about and have a great deal of admiration and respect for. So let's talk for a bit about who David Swenson is. David Swenson is the Chief Investment Officer and Manager of Yale University's Endowment Fund. And under his leadership from 1998 to 2008, Swenson generated 20 years of consecutive positive returns for Yale's endowment fund, which is pretty remarkable. He's known as one of the world's greatest money managers. In 1985, Swenson came to manage the Yale Endowment Fund, and at the time, 1985, it was worth $1 billion. Now, June 30th, 2017, it was worth $27.2 billion. So Swenson, over the course of 30 years, made Yale over $30 billion. In his book, Unconventional Success, a fundamental approach to personal investment, he lays out a portfolio tailored for the individual investor that is based on his strategies that he used to grow the Yale Endowment Fund. This portfolio contains 6 core asset allocations. Let's talk about them. So Swenson suggests you buy 6 index funds. You put 30% of your money in the total US stock market. Then you take 15% and put it in international markets. Then you take 10% and put it in national US emerging markets. Then you take 15% and put it in US REITs, that's US commercial real estate securities. Then you take 15% and put it in US Treasury bonds. And then you take 15% and you buy one fund of Treasury inflation protected securities. Okay, so there's a couple things to point out about the Swenson model portfolio. So in his book, he describes giving 5% to emerging markets and 20% to US REITs. But in a 2015 interview with NPR, he actually suggested 10% in emerging markets and 15% in US REITs. So as you can see, all these portfolios, you can do slight adjustments to them. Also, in his book, he uses a 70-30 asset allocation between stocks and bonds. So let's just look at the annual returns for the past few years. And let's stick with the 60-40. So in 2017, the portfolio grew 13%. In 2015, it didn't do so well. It went down by 1%. In 2014, it grew by 8%. In 2013, 9%, etc. Okay, everybody, so now you know, 1, your stock bond allocation based on your risk, personality type, investment horizon, age, how you see the world, how you see the future's behavior. Now that you know your stock bond allocation, you also know how to divide up your stock allocation based on index funds. So you have the entire portfolio structure picked out for you, and you know that you just need to buy a few funds and then you can set it and forget it. But you can't set it and forget it forever, because now we're going to talk about how to rebalance your portfolio. Now, keep in mind, all the portfolios we talked about are known as lazy portfolios. So that means you only have to rebalance them semi-annually or annually. The reason for that is because these funds throughout the year are going to grow and shrink at different rates. So over the course of a few months to a year, they're going to slowly fall out of balance from the model that you chose at the beginning. So every 6 months, calculate the percentage of money currently allocated to each asset class. Then go back and look at the model and see how it should be based on the model you've selected, and then all you need to do is make a few trades, buy and sell, and reallocate your positions to the model that you originally chose. Then you can forget about it for another 6 months to another 12 months and then come back and do the same thing. It only takes a few clicks. It's pretty easy. Now again, this is a long-term strategy. So only dive into this if you're planning on staying in the market for about 5 to 10 years. The reason for that is so that you can weather any storm of a market collapse and give your investments time to recover in case anything happens. Now, even when the market plummets, if you keep investing into this portfolio, when the market does recover, you can make some serious bucks. All right, everyone, so just quick disclaimer, all of the information in this video is for entertainment purposes only. So before making any serious financial decision that could affect your life, be sure to speak with your own CPA and attorney and get advice tailored to your exact situation and your exact goals. Awesome, so thanks so much for watching and supporting my videos and supporting my channels. It means so much to me. I really, really appreciate it. If you like this content or found anything I had to say useful or valuable, I would hugely appreciate it if you hit the subscribe button, smash the like button, ding the notification bell, leave a comment below with any comment, question, if you agree with me or disagree with me, and just let me know what you think about what I said. All right, everyone, I'll see you guys in the next video. Have a great day.